All right, guys, so in this module, we're going to be talking about insured mortgages and conventional mortgages. What is an insured mortgage? What is a conventional mortgage? The differences, the pros, and the cons. So let's start off with an insured mortgage. What is an insured mortgage? So an insured mortgage is a mortgage that has default insurance on it, right? So a default insurance provider is CMHC, Genworth Canada, Canada Guarantee. Three parties in Canada that provide default insurance to our mortgage. So technically what happens in this scenario is it's kind of like when you're driving a car, you need to have, let's say, car insurance, which is mandatory, right? So in this situation, if you're putting less than 20% down, it's mandatory to have default insurance on your mortgage. And I get a lot of clients asking me, is insurance more beneficial to me, or what is it all about? So the insurance is technically more beneficial to the bank, right? So it's called default. So let's say if you are going to default on that mortgage, the bank is insured. That means that CMHC, Genworth, or Canada Guarantee will actually pay the bank the balance of the mortgage, right? So that kind of protects the bank. So you have to pay for that because that's technically your mortgage. So what happens in that scenario is it just get added to your mortgage, or you can pay cash separately or pay it separately. I would say 9 times out of 10, clients just add it to their mortgage because it can be a fairly decent amount, right? So if you're putting 5% down, there's a 4% insurance premium, meaning it's almost really close to the amount of down payment that you're bringing in, right? So if you're coming with down payment and then you're also coming up with insurance premium, it's probably not the smartest idea. And if you are doing that, it's probably smart to put that as your down payment to reduce your insurance premium to finance the rest, right? So it doesn't really make sense for a lot of clients to pay their own insurance premium. It, like I said, 9 times out of 10, it gets added to their mortgage. Now, if you go from 5 to 10%, now you put 10% down, the insurance premium drops from 4 to 3.1. Is once again, insurance is based on risk. So you're less risky if you're putting larger down payment, and then vice versa, right? Now, 10 to 15, the insurance premium drops from 3.1 to 2.8, all right? So once again, low risk with higher down payment. Then as soon as you hit 20, you can bypass insurance altogether, and you don't have to worry about it. Now, what are the pros of having an insured mortgage? One, technically, banks like to have insurance on their mortgages, right? It's because now they're insured. You usually get better rates because they kind of like, at the end of the day, there's no risk on that. So they will try to give you better rates than compared to someone that has no insurance on their mortgage. And then sometimes some things make sense, right? So some insurance companies have certain programs for certain individuals that they could do under an insured program that maybe banks won't do if it wasn't insured, right? So a really important one is stated income. So Genworth Canada has a really good stated income program. It's good for self-employed people. And the biggest problem self-employed people have is that they're making good income, but they don't have traditional ways of showing that they're making good income, right? They might not have all the documents available. So Genworth Canada and the bank are now allowed to use other sources to kind of confirm income, things that they kind of feel comfortable with, and it kind of helps them get a mortgage. Now, most banks don't have a stated income program outside of Genworth Canada, which is insurance, right? So if you're a self-employed person and you have 20% down, there's a good chance maybe you don't get approved, right? And as long as that bank doesn't have a stated income program. So you might want to put 10% down, and then go through the stated income program with the insurance company. The other one could be a New to Canada program. Right now, banks now are not, probably if you don't have the credit, you haven't been in the country for a certain time period or a longer time period, banks might shy away from that. But if you're going through insurance, it makes it a lot easier. Once again, I'm going to use Genworth Canada as an example. Let's say you've been in the country for 6 months and you don't really have any credit. Most banks are not going to approve you with 20% down. With Genworth Canada, what they can do is they can take 10% down and they can just go off something as simple as 6 months of bank statements just to confirm you've been in the country for 6 months. It's a very easy thing to provide. Most people who come into Canada, first thing they do is open up a bank account, right? So if you've been here for at least 6 months, you got 10% down, there's a really good chance you can get a mortgage through insurance. So there are some benefits of insurance. Banks like it. There's also limitations to mortgages with insurance on it. So now, since it's an insured mortgage, the final approval, the final say comes from the insurance company, right? So the first step is you get the bank approval, then it's subject to the insurer's approval, right? So you'll see a lot of pre-approval letters state that in it, saying that it has to be approved from the insurance company, or it's not valid, right? So what happens in that situation is if the insurance company, and they have stricter rules, insurance companies, right? So they have less leeway. So for example, ratios are very, like, it's a hard and fast rule, right? So if you have good credit, it's a maximum of 44%. You can't go over that. It doesn't matter what the situation is, right? You can have $1 million in the bank, but if your ratios are over 44, the insurance company is not going to approve that, right? So there's minimum credit scores as well. So like minimum of 600 is what the insurance companies look at. If you have a score lower than 600, once again, it doesn't matter. They're not going to look at it. Hard and fast rule, right? So conventional mortgages, they're a little bit more flexible. Banks can actually use their own underwriting policies, try to kind of make sense of something. But with insurance companies, it's very restrictive sometimes. Income has to be a certain way, all of that stuff. So it kind of really just depends on that. Max for insured mortgage for amortization, which is considered to be life of the mortgage, is 25 years. You cannot go over 25 years at all, right? So it means that you now have to qualify for whatever home that you're buying for a max of 25 years based on their requirements of the insurance company. Now, what is a conventional mortgage? So conventional mortgage is when you hit a threshold of 20% down, it becomes a conventional mortgage, right? So it makes it a lot easier for banks to take a look at that time. So conventional mortgages come with different pros and cons. Number one pro is now you don't have any CMHC insurance on it, right? That's the first thing. So you save some money there. You have a large down payment, so your borrowing amount decreases. You don't have to worry about paying interest on the insurance, right? Because usually what happens with the insurance, it gets added to your mortgage, and there's interest being charged on that insurance. So with conventional, you don't have to worry about that. We can go up to 30 years on conventional compared to the 25 years on the insured. So it increases the life of the mortgage, reducing its payments, making it easier for you to qualify. Usually going from 25 to 30 years, it's about maybe a couple $100, maybe more, reduction in your qualifying payments and your actual mortgage payment. So that kind of helps qualify. And the banks have a lot more flexibility when it comes down to 20%. Maybe they can go above the 44%, maybe they can go slightly higher than that. It really just depends on the scenario, but banks, if you have a very, let's say, not a normal situation, it's like I say, it's a special circumstance, then the chances with 20% getting approval is a lot higher than getting approved with, let's say, 5% or 10%. Now, a lot of people ask me this as well. So if you're putting 20% down, it would make sense you get a better rate, right? Because you're putting a larger down payment down, you're getting, if the bank has more of your money, or let's say the bank's lending you less, should you get a better rate? It doesn't work that way. So usually with 20% down, rates are usually higher than insured. Let's say someone who puts 20% down, good chance they'll pay a higher rate than someone who pays 5% down, right? So why is that? And the reason is because, once again, there's no insurance on that mortgage, right? So the first person who's putting 5% down, he's actually fully insured, right? So to the bank, that's the least amount of risk, even though he put a least amount of down payment. But someone who's putting 20% down, the bank's still taking somewhat of a risk. So what they have to do now is they'll might likely have to get like a third-party insurance company or something to kind of back up that insurance, and their cost goes up and they pass that cost on to you, right? So that's technically what happens in that scenario. So usually larger down payment, a little bit of a higher rate, but at the end of the day, is it worth it? It still makes sense, right? And the reason is this. So if you're putting 20% down, you save your CMHC insurance or Genworth insurance or your default insurance right up front. So your payments are going to be lower. Your interest rate might be a little bit higher, but your interest cost will definitely be lower than would it be with 5% down, because you're just borrowing less, you're not paying interest on the insurance, and overall it just kind of makes sense. So sometimes even with the higher rate, it kind of makes sense to kind of put the down payment down, which is more, so you can get it paid down a little bit sooner.